If you are holding silver right now, do not click away, because this week, Bank of America dropped a message that sounds like an insult, a warning, and a roadmap all at once. They looked at this silver run and basically said, this is not fundamentals, this is narrative. And then they put two numbers on the table that do not belong in the same room. Number one, $60. Number two, $170. So the question is not, can silver hit $170? The question is, why would the same bank say $60 is fair value and also map a path to $170? Today is January 17th, 2026. Silver is hovering around the $90 area after tagging an all-time high above $93 and then cooling off. That means the metal is up roughly 25% year to date, and we are not even 3 weeks into the year. Now enter the BofA note. Their metals strategist, Michael Widmer, says the rally has gone beyond what fundamentals justify. His estimate, a fundamentally justified price, is closer to $60 per ounce right now. But in the next breath, he says retail flows are so powerful that if they keep increasing exposure at the same pace, the math could justify a move toward $170 over roughly the next 2 years. The internet heard that and translated it into one loud sentence. Bank of America just called silver a scam. So in this video, we are going to do 3 things, fast and clean. 1. What BofA actually said and what they did not say. 2. Why $60 and $170 can both be true inside a Wall Street model. 3. How you protect yourself from the one thing Widmer did warn about, violent price swings. Quick disclaimer, this is education, not financial advice. Manage your risk. Did they really call silver a scam? Let me be precise. The report does not need to use the word scam for it to function like a scam accusation. Wall Street has a cleaner phrase for it, overvalued and meme-driven narratives. That is the polite version of saying, this move is being powered by people who are chasing a story, not a spreadsheet. And if you have watched markets long enough, you know why that matters. If they can label you meme money, they can dismiss you. If they can dismiss you, they can survive you. Here's the core of the BofA message as it is being quoted. Silver has become wildly overvalued versus what their models call fair value. They estimate fundamentals point closer to $60. They are concerned about further violent swings. But they do not deny the upside. In fact, they admit the upside math. That combination is what is setting people off. Because to a retail investor, it sounds like this. You are wrong, you are irrational, you are late, you are about to get hurt. Also, if you keep buying, the price can double. That is not an accident. That is a very specific kind of messaging that does 2 jobs at the same time. Job 1, cool the crowd. Job 2, keep the door open for the bank to be right no matter what happens. If silver drops, they say, we told you $60. If silver runs, they say, we told you $170 was possible, just a tall order. Now, before we go full conspiracy, I want you to understand something. Banks do not write research the way you write comments. They write it the way a pilot reads turbulence. They are managing liability. They are managing positioning. They are managing client emotion. So the question is not, are they evil? The question is, what incentives does this message reveal? And to answer that, we have to understand the 2 numbers. Where does $60 come from? When a strategist at a bank says fundamentally justified, they usually mean this. They have a model. The model takes a basket of inputs and it spits out a number. Think of it like a weather forecast for commodities. It is not saying, this is what reality must be. It is saying, if these conditions are true, we expect this outcome. So what kind of inputs? Usually things like the US dollar, real rates and inflation expectations, industrial activity, investor flows into ETFs, and sometimes positioning in futures markets, and then they compare today's price to that model output. If price is way above model, they call it overvalued. Here is the trap. A model is blind to panic and blind to scarcity. A model is also blind to reflexivity, the idea that rising prices pull in more buyers, which pushes prices higher, which pulls in more buyers. That is not a bug. That is a feature of markets. Silver is special because it is a metal with 2 personalities. Half of the world treats it like a commodity. The other half treats it like money. So on calm days, it trades like an industrial input. On fear days, it trades like a referendum. If your model is built for calm days, and the market is living through fear days, your model will always look like it is being disrespected. This is why Widmer can look at the same chart you are looking at and say, this move is too far, because his model is asking a different question. Your question is, where can price go? His model question is, where would price settle if the crowd left the room? That is what $60 really represents. It is not a prophecy. It is the bank's way of saying, if this turns back into a normal metals market, we think the normal price is lower. And that would be a totally fair point if this were a normal metals market. But look at what is happening in early 2026. We have geopolitical stress, rate cut expectations, a weaker dollar, and a full year of investors treating silver like a core macro asset. Retail inflows have not been random dips. They have been persistent. That changes the floor. So now we reach the second number, the $170 or math. This is the part most people missed. BofA did not say, silver will be $170. They said something sneakier and more important. They said, if retail investors keep increasing their exposure at the same pace we saw in 2025, then the upside math could justify roughly $170. Translation, it is not about mine supply alone. It is not about industrial demand alone. It is about flows. Here is why flows matter more in silver than almost any other mainstream asset. Silver is not the S&P 500. It is not the treasury market. It is not even gold. The tradable silver market is relatively small compared to global capital. So when a new wave of money decides we are allocating here, the price has to move to make room. Think of a nightclub with a tiny doorway. The crowd does not politely file in. The doorway becomes the price. Now, what does keep increasing exposure actually look like? It looks like nonstop ETF demand. It looks like retail accounts adding silver as a standard position, not a lottery ticket. It looks like momentum funds that were never supposed to touch silver being forced to chase because the chart is embarrassing them. And in early 2026, we have real-world evidence that something has shifted. Silver did not just have a pop. It had a year, a near 150% year, and then it started 2026 by adding another roughly 25% in 2 weeks. That is not how a dead commodity behaves. That is how a crowded trade behaves. So why would a bank even mention $170? Because banks do not like being surprised. They would rather scare you with the size of the move than be caught pretending it cannot happen. And this is where the title of this video lands. The $170 lie is not that $170 is impossible. The lie is the framing. Because when they present $170 as a warning, they are implying it is your greed that would cause it. When the more honest framing is this, a small market plus relentless flows equals violent repricing. That is not a moral story. That is math. Now let me show you the actual trap hidden inside the warning. The trap is the swing. When a strategist warns about a violent swing, they are not just describing a chart. They are describing a behavior pattern. Silver is famous for this. It rips higher like it has discovered a new law of physics. Then it drops fast enough to make you feel stupid for ever believing. Then it recovers and keeps going. The swing is the weapon. Because the swing is what forces the weak hands to pay the strong hands. Here is how the play works in the real world. Step 1. Define a level where the crowd starts to feel safe. Right now, that level is the $90 handle. It feels like a new floor. It feels like support. Step 2, let the crowd build positions on that new comfort zone. People stop thinking about downside. They start fantasizing about 100, 120, 170. Step 3, hit the market with a narrative, not a bullet, not a ban, just a narrative. Meme-driven, overvalued, fair value is $60. Step 4, when the price dips, the new buyers do not have a plan. They do not know if this is a pullback or a collapse. So they do what humans do. They sell to stop the pain. And step 5, the market finds out who actually wanted exposure and who just wanted applause. That is why the $60 headline matters. It is not only analysis, it is an invitation for doubt. But there is a twist. If BofA is right about one thing, it is this. If we are entering a new era where silver is treated like a core macro asset, the swings can get bigger, not smaller. Because more money means more leverage, more options, more hedging, and faster panic. So if you are going to play this game, you need rules, not vibes, rules. And that brings us to the part of this video that actually helps you. The survival plan, how to hold silver in a violent market. I'm going to give you a simple plan you can follow even if you have never traded a commodity in your life. It is not about predicting $60 or $170. It is about staying alive long enough to see which path wins. Rule 1. Split your position into 2 boxes. Box A is your core. Box B is your trade. Your core is what you hold because you believe the macro story. Debt, inflation, geopolitics, and the re-rating of hard assets. Your trade is what you hold because you believe volatility will give you better prices. If you do not split it, you will do the worst possible thing. You will sell your entire position at the exact bottom of a scary candle. Rule 2. Size it. So a 25% drop does not change your life. Read that again. In a market that can do $10 moves, you must assume a 25% drawdown is not rare. It is normal. So if a 25% drop would force you to sell, your position is too big. The market is not wrong. Your sizing is wrong. Rule 3. Do not use leverage if you are here for the thesis. Leveraged ETFs, margin, short-dated options, they turn a long-term thesis into a short-term gamble. Banks love leverage because leverage creates forced sellers. Forced sellers create liquidity. You do not want to be liquidity. Rule 4. Enter like a professional. Stop buying all at once. Use tranches. Here is a practical example. If you want $10,000 of exposure, buy $2,500 now. Then set 3 levels where you add $2,500 more. One level is a mild pullback, one level is a scary pullback, one level is the headline panic pullback. This way, you are not begging the market to be kind. You are prepared for the market to be cruel. Rule 5. Pick the right vehicle for your temperament. Physical silver is slow, heavy, and real. It is harder to panic sell. That is a feature. ETFs are liquid and fast. That is useful, but it is also a temptation. Mining stocks are leverage on top of leverage. They can outperform and they can also betray you. If you are new, keep it simple. If you want to sleep, go heavier on the vehicle. You cannot rage click sell. Rule 6. Track flows, not just opinions. The whole BofA argument is about flows. So do not just watch price. Watch whether the crowd is still allocating. When inflows are steady, dips are usually pullbacks. When inflows reverse, dips can turn into air pockets. Rule 7. Have a profit-taking rule before the hype day. If silver hits a round number like $100, you are going to feel invincible. That is when you make mistakes. So decide now. Maybe you sell 10% into strength to de-risk. Maybe you move some gains into cash. Maybe you rebalance. Taking partial profit is not betrayal. It is oxygen. Rule 8. Do not let a bank's fair value become your stop loss. This is subtle. When you hear $60 fair value, your brain creates an imaginary cliff. You start thinking, if it goes there, I must be wrong. But remember what we said. $60 is a model output for a calm world. If you believe we are not in a calm world, you do not let a calm world number control your emotions. Now, with that plan in your head, the whole BofA memo becomes easier to read. It is not a commandment, it is a stress test. And the hidden message is this: even the skeptics admit the path to $170 exists. They just think you will not survive the swings required to get there. So do not let them win with psychology. Win with structure. If you want, I will do a follow-up video where we map the 3 scenarios. Scenario A, silver mean reverts toward model value. Scenario B, silver chops sideways and bleeds the leverage out. Scenario C, flows stay relentless and the market reprices toward triple digits. Comment one word below, model if you think $60 wins, or flow if you think $170 is in play. And if you want more content like this, subscribe, because the next move in this market will not just be about price, it will be about who can stay in the arena.